Gold isn't T surging because people suddenly got scared. It S surging because inflation expectations just tilted the math in gold OS favor. And the uncomfortable part is this. A lot of commentators are going to keep calling it quiet, grindy, headline-driven, because admitting the real driver means admitting the market is repricing the future faster than institutions can control the narrative. But that's not the part that matters. The part that matters is what this sets up for the next 1 to 2 weeks. The levels that decide whether gold reloads or rips. The calendar window that forces portfolios to show their hand, and the one metric that, once you start watching it, makes the whole move feel less like a mystery and more like a mechanism. Here's the conflict. The mainstream story always shows up late. It's reactive. It waits for a clean headline that sounds smart in a sentence. Geopolitics. Risk off. Central banks. Dollar down. And yeah, those things can be true. But when gold moves in a way that doesn't T-match the lazy narrative, when it keeps pressing higher even as people keep saying rates are still high, that is your signal that something structural is happening. Something that doesn't care about your opinion. Something that forces participants to do things. And forced behavior is what moves markets. So let's put real context around the tape right now. Over the past few weeks, gold has traded a range that should make you stop and recalibrate. We've seen lows in the low to mid 4300s and highs flirting with the $5,000 area. That's not a sleepy drift. That's a market that is repricing. And if you're watching this as a retail investor, a macro watcher, a metals person who's been skeptical of the institutions for years, you already feel the tension. The narrative is calm, but the price action isn't. That disconnect is where the pressure starts. Now, the hidden driver I want you to lock in is not CPI itself. It's not even inflation in the abstract. It's inflation expectations. What the market thinks inflation will be, not what last month's report said. That's the quiet catalyst. When inflation expectations snap higher, gold doesn't need a crisis to move. It just needs the discounting mechanism to change, because gold is not a yield asset. It doesn't pay you. So the entire argument around gold often collapses into one battle. What is the opportunity cost of holding it? And that opportunity cost is not nominal rates on a headline, it's real rates, nominal yields minus expected inflation. And when expected inflation rises faster than nominal yields, real rates ease. And when real rates ease, even slightly, gold suddenly has oxygen. That's the mechanism. That's the steering wheel. Here's why this matters right now, this week. Markets don't move on what you think should happen. They move on how the math is changing. If the bond market is pricing a higher inflation path, or even a higher uncertainty band around inflation, then the future cash flows of everything get discounted differently. Equities feel it, credit feels it, the dollar feels it. And gold, because it sits outside that cash flow discounting game, gets revalued as a hedge and as an alternative reserve asset. But the key is the sequencing. You'll often see the expectations move first, then the positioning, then the media story. And by the time the story becomes common, the trade becomes crowded. That is why you done until you want to be the person who starts paying attention when the headline finally catches up. But there's another layer to this that most people miss. Because inflation expectations aren't just a vibe. They are embedded in market instruments. Breakevens, those spreads between nominal treasuries and inflation-protected securities, are the market AS live estimate of expected inflation over a horizon. When that break-even line rises, it's telling you investors are demanding more compensation for inflation risk. That doesn't require inflation to be exploding this instant. It only requires the market to believe the path is stickier, the downside is limited, or the uncertainty is increasing. And the next detail is what flips the whole setup. Uncertainty itself can be bullish for gold, even if the level of inflation doesn't look dramatic. Because uncertainty changes hedging behavior. It changes demand for convexity. It changes how funds allocate into things that don't rely on someone else's promise. And that's why this move can feel quiet. It's not a panic candle. It's not a single day where everyone screams. It's a steady repricing as portfolios reweight. That kind of move is more dangerous for shorts. It's more dangerous for anyone waiting for the perfect pullback. Because it's a grinder that builds pressure, and grinders tend to end with either a clean pullback and retest that rewards patience, or an air pocket squeeze that punishes hesitation. Keep that in mind. Now let's talk about the data that feeds this. December CPI came in firm enough to remind the market that disinflation is not a straight line. You can argue the details, shelter, food, categories rotating, but the takeaway is simple. Inflation is not collapsing on command. And when inflation isn't collapsing, the idea that the central bank can cleanly glide to rate cuts without consequences becomes less certain. That uncertainty pushes up the inflation risk premium. It pushes up inflation expectations at the margin. And when expectations rise at the same time as the market is staring at policy meetings and month-end rebalancing, you get a setup where the quiet catalyst becomes a loud tape. Because if one level breaks, the math changes. Now, zoom out one notch. A lot of people treat inflation expectations like a footnote. They'll say, okay, fine, break-evens moved. But they don't connect it to behavior. Here's the behavior. If you're a portfolio manager and your expected inflation path just nudged higher, you have a problem. Your real return assumptions shift, your bond exposure behaves differently, your equity multiples become more fragile, and your mandate didn't change. You still have to deliver performance. So you do what institutions always do. You adjust around the edges first. You add inflation hedges, you add real assets. You add a position that can survive a regime where money isn't T as Carrotus hard as it looked a quarter ago. Gold becomes less of a trade and more of a policy hedge. And you can see it when it's real by looking at plumbing. The first place institutional fear becomes measurable is in flow. Not in a tweet, not in a segment, in flow. When exchange-traded products tied to gold start taking in capital, especially if it S sustained, it S telling you the market is not just trading gold, it's allocating to it. That's a different animal. Trading is fast money. Allocation is slow money. And slow money creates the kind of bid that doesn't disappear on the first red day. But that's not the only signal. Because if you want proof that this isn't only sentiment, you look for friction. You look for places where the market has to pay up, where the spread starts talking, where the easy supply isn't as easy. This is where the physical versus paper tension comes in. And I want to be careful here because people get conspiratorial and sloppy. You don't need to claim manipulation to understand incentives. Futures markets are built for hedging and price discovery, but they also allow leverage. Leverage is powerful until it becomes fragile. When the market is calm, leverage looks smart. When the market trends, leverage becomes a trap. Now in metals, the paper market, futures and derivatives, can move faster than physical supply. Physical supply has lead times. Mining output doesn't respond in a week. Refining capacity doesn't scale overnight. Logistics don't teleport bars to where they're needed. So when demand changes, the first thing that changes is price, then spreads, then inventory behavior, then premiums. And it doesn't happen evenly. It happens where stress is. So what do you watch if you want to know whether this gold move has structure behind it? You watch the curve. Is the futures curve in contango reflecting normal carry costs and convenience yield, or is it flattening? You watch near month versus far month spreads. You watch whether liquidity is thinning around key contract windows. You watch delivery behavior in warehouse categories. You watch whether deliverable inventory is behaving differently from non-deliverable or eligible inventory. And you watch whether there are signs of tightness showing up in premiums or in the urgency of certain market participants. Because the tape can lie. The spread is harder to fake for long. The next detail is what flips the whole setup. If there is even a hint that physical demand is pulling forward, the paper shorts become far more sensitive. Because if they're wrong into a market where supply can't instantly appear. Now, layer the macro drivers. Gold doesn't require the dollar to crash. It just requires the dollar to lose certainty. And there's a difference. A crashing dollar is a dramatic story. The loss of certainty is quieter. It's drift. It's reallocation. It's a slow roll where global holders start thinking, what is my real purchasing power risk? What is my policy risk? What is my geopolitical risk? And you didn't have to be a doomsday person to see that the past few years trained institutions to care about tail risks they used to ignore. That's why gold can move even in a world where nominal yields look high. If expected, inflation moves, and if uncertainty rises, and if the dollar's path becomes less reliable, the calculus changes. And there's one more layer that makes this feel different. Reserve behavior becoming public. When repatriation debates and custody arguments start appearing in mainstream conversation, that's not a price chart. That's a trust signal. It's not proof of some secret plan. It's evidence of incentives shifting. Governments and large institutions diversify for reasons that are boring until they aren't. Policy risk, sanctions risk, domestic politics, the desire to be less dependent. Gold is uniquely positioned in that conversation because it is no one else's liability. That matters more in a world where institutions are asking uncomfortable questions, and that's where the real pressure starts. Now, let's talk about the calendar, because why now is not optional. Markets don't move in a vacuum. They move through windows. And this week sits inside multiple windows that can amplify gold's reaction to inflation expectations. You have month-end approaching. Month-end matters because large funds rebalance. They have targets, they have risk budgets, they have mandates that force them to buy or sell regardless of what they personally think. You also have a Federal Reserve meeting window right in front of you. Whether or not the Fed changes anything, What matters is guidance and the market's interpretation. Because gold doesn't trade the Fed's words. It trades what those words do to real rates, the dollar, and inflation expectations. Here is the key. If the market believes the Fed is constrained, meaning inflation is sticky enough that the Fed can easily pivot, but growth or financial stability constraints mean it also can easily tighten, then you get a regime where inflation uncertainty persists. That's fertile ground for gold. It's not a one-day headline. It's a multi-week repricing. And if liquidity is thinner, as it often is around key calendar points, moves can overshoot. That's how you get gaps. That's how you get squeezes. That's how you get the kind of tape that makes people emotional. And that's exactly when the market tries to break you. So let's build the proof stack cleanly without leaning on one argument. First, price context. Gold has been pushing into the $5,000 region after trading much lower in the low 4,300s earlier in the month. That's a major repricing in a short window. Second, inflation expectations. Break-evens have been nudging higher enough to change the real rate calculus. Third, CPI firmness. The inflation narrative is not collapsing. It's sticky enough to keep the risk premium alive. Fourth, institutional behavior. You can see signs of allocation behavior through the ETF and portfolio hedging conversation. Fifth, macro backdrop. Dollar certainty is wobblier, and policy uncertainty is feeding diversification demand. Sixth, market structure. The curve, spreads, and delivery windows are the places where tightness and stress show up first. And here's the kicker. You don't need every proof point to scream at once. You just need enough of them pointing the same direction to understand why this is happening now. But I'm not going to pretend the bearish case doesn't exist. It does. And if you want to be credible, if you want to actually make money over time rather than just feel right, you have to respect it. The bearish case is straightforward. If real yields stay pinned high, gold has an anchor. If the market decides inflation expectations were a fake out and break-evens roll back down, that anchor gets heavier. If positioning gets too crowded, a pullback can be violent. And if the dollar catches a bid on some surprise or on risk-off flows into treasuries, gold can get hit even if the long-term thesis is intact. That's not doom. That's market structure. That's how leverage and liquidity interact. And that's why you must separate trend signal from noise. Here's how to do that without overcomplicating it. Trend signal is what holds across days and weeks. Noise is what happens intraday, or on a single headline, or on an algorithmic sweep when liquidity is thin. In gold, noise looks like sharp spikes down and up that reverse quickly. Noise looks like a scary red candle that gets bought back within hours. Noise is designed to trigger your emotions, and emotions are expensive. The market knows retail, and even professionals have a weakness. They interpret volatility as information. But volatility is often just liquidity stress. It's often just positioning getting cleaned out. It's often the market running stops. And that's why I'm going to give you a psychology shield right now, because if you don't have one, you'll get chopped. The market's favorite trick is to shake you out after you got the thesis right. It will let you build confidence, then it will hit you with a sudden drop. Then it will flood your feed with reasons why you were wrong. Then it will bounce without you. That's not conspiracy. That's incentive. Liquidity providers profit from flow. Funds need entry points. Shorts need exits. The easiest way to create flow is to create emotion. So when you see a sudden downdraft, ask a better question. Did the mechanism change? Did inflation expectations collapse? Did real rates spike? Did the dollar suddenly regain certainty? Did the curve and spreads shift? Or did price just whip because liquidity thinned and stops were close? That question alone will save you money. Because if the mechanism didn't change, the move is likely noise. And if the mechanism did change, you want to know early, not after you've rationalized losses. Now let's get practical. What are the levels and triggers that matter in the next week or two? The first obvious reference point is the psychological and technical area near $5,000. When price flirts with a round number like that, behavior changes. Options positioning clusters, stop orders cluster, headlines cluster, that can either cap the move temporarily or it can create a burst if it breaks cleanly. But don't get hypnotized by the round number alone. The more important question is whether gold can hold gains above its recent breakout region after any pullback. In other words, if we pull back, where does demand show up? A reasonable first defense zone sits in the mid to high $4,800. Why? Because that area often becomes the battlefield between late buyers and disciplined buyers. If gold holds that zone and starts to turn, it suggests the bid is real. It suggests allocation demand is supporting, and it suggests the move is not just a spike. But if gold loses that zone quickly and can't reclaim it, then the market is telling you it needs to reset. And the next level that matters is deeper, closer to the mid 4,600s. That's the line where the story can shift from pullback and reload to trend damage, at least in the short term. Because if that breaks with momentum, you're looking at a larger unwind. And that's when you want to be humble and ask whether the hidden driver, breakevens, and real rate dynamics, just flipped. Here's the part most people skip. You don't watch levels in isolation. You watch levels alongside the mechanism. If gold is pulling back, but inflation expectations remain firm, real yields aren't spiking, and the dollar isn't ripping higher, then the pullback is more likely a retest. That's scenario one. Controlled pullback, retest, rebuild. It feels boring. It feels frustrating. It shakes out weak hands. It invites commentary that the move is over, and then it resumes. But scenario two is the one that makes people angry. Continuation squeeze. That's where gold doesn't give you the clean pullback. It chops, then it gaps, then it runs, and the people waiting for perfect entries end up chasing. That scenario becomes more likely if options dynamics and positioning create forced buying. If the market is short gamma near a key strike zone, hedging can accelerate moves. If shorts are leaning into resistance and the level breaks, they become forced buyers. And forced buying is gasoline. Now, I'm not saying gamma squeeze to be cute. I'm saying it because metals markets can absolutely reflect options-driven reflexivity, especially around large round numbers and around contract windows. When dealers are short calls and price rises, they hedge by buying futures or underlying exposure. That buying pushes price higher, which forces more hedging. It's a feedback loop. It doesn't last forever, but it can take price further than fundamentals alone would justify in the short term. And that's why if $5,000 breaks and holds, you need to be ready for acceleration. Not because it's magic, because the math forces it. And that's where the real pressure starts. So what would confirm the bullish thesis in the next week or two? 3 things. First, inflation expectations staying firm or rising, break-evens not rolling over sharply. Second, gold holding above key support zones on any pullback. Buyers stepping in with intent, not just a dead cat bounce. Third, the dollar staying uncertain. No sudden sustained surge that raises the opportunity cost of holding gold. Add a fourth, if you want extra confidence, signs of continued institutional allocation, whether through flows or through the tone of how big desks talk about hedging. Those are the confirming signals. What would weaken or invalidate it? Again, be clean. A sharp reversal in inflation expectations, break-evens dropping meaningfully, would be a warning. A surge in real yields would be a warning. A sustained dollar rally would be a warning. And a breakdown through that deeper support zone in the mid-4600s with momentum would tell you the market is moving into a larger reset. That doesn't mean gold is dead. It means the short-term structure is damaged and you need to adjust your risk. That's how you stay in the game. And let's talk about risk in plain language, because this is where people lose trust. Even if the thesis is correct, price can whip around violently. That's not a flaw in the thesis. That's a feature of modern markets. Leverage, algorithmic liquidity, and options exposure create air pockets. You can be right on direction and wrong on timing. You can be right on the macro and still get shaken out by volatility. So you don't bet your identity on one candle. You don't size like you're immortal. You respect that gold can drop fast, recover fast, and do it in a way that makes you doubt yourself at the worst possible moment. That's the psychological trap. So here's a simple shield you can actually use. Before you react to volatility, anchor to a checklist. Did inflation expectations change? Did real yields change? Did the dollar change? Did the curve and spreads change? If 2 or 3 of those flipped, you have new information. If they didn't, you're watching noise. And if you're going to act, act with a plan, not with a feeling. Feelings are what liquidity farms. Now, I want to zoom back in on the quiet catalyst one more time, because it's easy to underestimate how powerful this is. Inflation expectations are not just about inflation. They're about trust. They're about whether the market believes purchasing power will be protected. They're about whether policymakers can thread the needle. When expectations tick higher, it's a small admission that the system is not fully in control, and gold is the asset that has lived through regimes where systems weren't in control. That's why this can build without a dramatic headline. It's the market gradually admitting uncertainty, and uncertainty is the fuel. That's also why you should expect pushback. You will hear people say gold is too high, overbought, irrational. You will hear people say the move is speculative. And sometimes those critiques will be partially true in the short term. Markets can overshoot. But the deeper question is not whether gold is high. The question is whether the regime is shifting. Because in a regime shift, too high becomes new range. And the only way you know if a new range is forming is by watching what the market does on pullbacks and by watching the hidden driver, not the noise. Let's translate all of this into what happens next, like a roadmap you can hold in your head. Over the next week, the market will be hypersensitive to anything that touches inflation expectations and policy interpretation. That includes economic prints, but it also includes the tone around the Fed meeting window and month-end positioning. If gold stays firm into that window and keeps pressing toward the highs, be ready for volatility spikes, both up and down. as liquidity thins and positioning adjusts. If gold pulls back early in the week, the question is whether it finds support above the mid to high $4,800. If it does, that's a constructive retest. If it doesn't, then watch the deeper zone around the mid 4600s and watch what break-evens do at the same time. Because if that one level breaks, the math changes. And if we get the squeeze scenario, if price pushes through $5,000 and holds, do not assume it will be smooth. Squeezes are messy. They gap, they retrace, they bait you into bad decisions. The right mindset in that scenario is not, I must catch the top. It's, what are the confirms? What is the invalidation? Where are the liquidity pockets? Because if you try to outsmart a reflexive move with ego, you will pay tuition. There's also a bigger message here for anyone who's been skeptical of institutions. You don't need to believe in cartoons to believe in incentives. Institutions manage narratives because narratives manage behavior. But the market structure, break-evens, real yields, flows, spreads, doesn't care about the narrative. It reflects what people are doing with capital. That's why watching the quiet catalysts is so powerful. It keeps you ahead of the story. It keeps you focused on mechanisms. And it protects you from being emotionally manipulated by the tape. Now, a subtle CTA. Because if you're watching this kind of market, you already know you don't need cheerleaders. You need a signal crew. If you want to stay sharp through this window, don't just watch price. Watch the driver. Watch inflation expectations. Watch real rates. Watch the dollar's certainty. And compare notes with people who care about mechanisms, not slogans. Because this is the kind of setup where the crowd will be loud right when the trade is most dangerous, and quiet right when the opportunity is best. And that's not an accident. So here, it's the final revelation, the one metric everyone needs to watch if they want to understand gold is Powys quiet catalyst in real time. It's not the CPI headline. It's not the daily news cycle. It is inflation expectations as priced by the market, because that is the lever that quietly shifts real yields, reshapes opportunity cost, and forces allocation behavior. Watch that line. And then watch what gold does around $5,000, the mid to high 4,800s and the mid 4,600s. Those aren't just numbers. They're decision points where one side gets forced, and forced behavior is what moves markets.